Good turnaround Tuesday, everybody. Hello, Hugo, Kevin, Sinatra. Thank you, Paul. Same to you. We have a special guest today. We have Mark Chandler. Good morning, Marco, Richard. Mark Chandler has been a stalwart in the FX arena for decades now. It's going to be great to have Mark with us. Shalom, Amira. So I thought I'd start off with this Dixie right here. And one thing we know for sure, 92 is a big area, okay? I mean, all you have to do is just, put in some type of kind of like a horizontal line here. Anyway, that's not working. Hold on. Yeah, trend line tools. Anyway, you could see 92 right here, one attempt after this initial decline from the highs. 1, 2, 3 attempts to break through this resistance here. I don't know what this is now. Anyway, so the Dixie, if we're going to continue this path, and we have the Fed, so we're going to see if they're going to, jawbone rates lower. Rates have started to pull back a little bit here, but you can't rule out, especially in the 30-year, another push up on the Fed. If the Fed doesn't talk really jawbone about how they're going to come in and do whatever they can to keep rates lower. But you have a pretty classic breakout here, so we'll see if we hold this breakout in interest rate futures. Really what came to life yesterday, and I went with it yesterday at the 85, 86 level. We've had a little pop. EG's trying to come out of here. Thought we might get one more low. I don't know if we're going to get one more low. I'm not going to, I've already taken partials on this, but not a bad looking day. Maybe we're going to try this 87.40 level again. I thought we would make a new low, but when we started really challenging some short-term moving averages here, I just went with it. Okay, so here we are. It's still looking pretty good. So what does that mean? So far, the high is confirmed in the dollar. So maybe we're going to break out. What's that, Sassy? Moves to the target zone, 133, 132.60. Okay, so you're talking about cable. All right. Anyway, what this means, if we have a turn here, and I think we could get, NASDAQ, okay. And just to take a look at the weekly off number, we're challenging it. It comes in at 86.05, so we're above it for a potential two-week reversal. Only it's pretty early in the week, right? It's only Tuesday. But, this was a lot of support here. This is where we really became impulsive in EG all the way back here. So I'm not calling for anything like this right now, but I don't know why we can't rally back to, say, 87.5 or so. Take it a day at a time. And we'll see what happens. The yen, I thought we were going to get one more high. That hasn't happened. We're trying to put in a reversal day here. I thought we were going to go to maybe 109.50. I still haven't pulled the trigger on this. This is kind of an interest rate play. And you want the yen, if you're a gold bull, you want US dollar yen to head down. So we'll see what happens. And the other observation before I turn it over to Blake is all the way up, while S&Ps would say have, 2% corrections or so, crude held. It doesn't seem to have the same type of fire in its belly that it had all the way up. So we had this high last week. I know it's a confirmed high there on short-term stuff, but the daily last week we talked about it diverging, and oil looks to be topping here, and 57.50 I think is possible. I'd sell rips in it. It doesn't seem to be as strong as we had um, in this phase of the advance, because S&P has made new all-time highs, and prior to this week, crude was leading the S&Ps to new all-time highs, and now it's lagging. So it's become the weak sister in risk. I'd sell rips here. There's could be quite a correction. In fact, why not back to 57.5 or even back to 60 would not upset the bull trend. But the oil's looking a little heavy to me. People are talking about Canada, and then I'll turn it over to Blake. I don't know. The VIX gap, I think, is filled at 1820. But anyway, I want to just talk about this. We're not diverging yet. I'm thinking down around the low 124s, there could be something to do in Canada, especially if crude is starting to fade, and eventually we get a move back over 92 in the Dixie. So any questions on anything I've talked about today so far? So with EG heading up, your preferred, when you're bearish a dollar, your preferred long is euro, your preferred short is cable, while this little shift in the euro pound is happening. Everyone get that? I know you're asking about the VIX. I believe the VIX fills at, no, we haven't filled that gap in the VIX. It's all the way back here. Here's your gap. It's going to fill at 1820. And we have some weekly 200-week moving average. It comes in at 1870. So yeah, even though we've made new highs in the S&Ps, we haven't filled this gap. So hope that helps. Okay. Yeah, it could be a correction. Sure. Not saying it's the beginning of a bull market. I'm just saying that we had a little bit of a change, and it's due for a correction. So with that being said, Blake, good morning to you. How are you? Good evening to you. How are you?
Good morning, Coach. How's it going over there?
Pretty good. Okay. Getting ready to
I see you
move at
making a
the,
play on the euro sterling.
yeah, yesterday. Yeah.
Yeah.
Yeah. So, I don't know why Euro sterling can't make a move up towards, 87.5 or so, maybe back to this base. And, I'm not predicting a big bull market, not yet, but it just started cutting through some moving averages. And I've been waiting for weeks to see if it would take out that low. And when it didn't look like it was going to take out the low, I just went with it yesterday.
Oh,
So,
nice. Well, the good news is it's probably carving out a higher low, which is good.
yeah.
Then the flip side of that is that, and let me go ahead and grab the screen over here.
Okay, buddy.
If you are looking at the euro sterling here, it broke through this major
Oh,
multi-year trend line,
yeah.
and if we can get a rally here, then you end up getting a false breakdown on like a weekly basis,
That's big.
and we could end up squeezing back towards pretty easily towards 87 pence, and beyond that, then you're really talking about a much bigger and broader
Right.
squeeze.
That's
So
trend line.
yeah, it's taking out a
I
couple
didn't
little
have
minor
that.
trend lines there. So
Yeah.
it's on the ones that have kept the market bearish, and then like I said, this long term trend line, we're back above it or trying to get back above it. So
Right.
yeah, so it's been a pretty quiet night. We've had one of the big moves that I wanted to point out is Bitcoin, and I'm looking at it now as like a head and shoulder pattern, possibly.
Oh,
I think we
mm,
can. I think I'm not in the camp that stocks are ready to turn over just yet, because they've been nothing but bullish. Every dip that we get is just a buying opportunity for the market. So, and even overnight in Europe, there's a little blip lower, and then all of a sudden after a blip lower, the market's like, pop right back up to all-time highs. So if that's going to be the case, then the Bitcoin market probably will recover a little bit towards that 57, 58,000 level. But I have a feeling that, this might have been the high from the weekend. And do you remember my reasoning, Dale, that we talked about at the end of last week?
For Bitcoin to pull back.
Yeah, remember we talked about Bitcoin. Well, you know what? I don't think we talked about it. Now that I'm thinking about it, I'm not sure that you and I talked about it. We talked about it a lot in the chat rooms, in the ForexAnalytix chat rooms. But basically, just saying that, hey, stimulus is coming out over the weekend. Everybody's going to get in and try to, buy Bitcoin, buy
Yeah, with their
Dogecoin.
stimulus check.
Stimulus checks are gonna, and the fact or the point that I was trying to bring there is that, and it's something that we talked about yesterday as well, is when we did talk about this, because I said when we were young and we were early years in our trading career, the big guys or the veterans would always say, hey, it's the top's in when mom and pop buy, but mom and pop's just not, mom and pop's been in because rates have been low. So really the mom and pop investors or the retail investors or the people, when I say retail, that's not necessarily correct or the right term to use to define who's getting in. I'm just going to say that the general public, late in the game, because those are the ones that, it's like, oh, I got a stimulus check, I'm going to put that into Bitcoin, I'm going to put it into, I'm going to buy some GameStop. It doesn't really matter what, just I'm going to buy some stocks because the stock market keeps going up. I'm going to buy cryptos because cryptos keep going up. And then they buy it over the weekend because they're like, I've got this stimulus check coming. I might as well just plow it into the markets. And, they buy it over the weekend, we peak. And then that's when, you suck retail in, you suck that last bit of retail investor in. And on Twitter, I called it's a big transfer of wealth. You get, you had hundreds of billions of dollars just plow into cryptocurrencies, and all the institutions that plowed hundreds of billions of dollars into cryptocurrency when cryptos were, Bitcoin was down at 20 and 30,000. They're out there selling it to you. So, not to you, but to people that were buying over the weekend. So, is that the top? I don't know, but I'm starting to think that it might be. And, we might get this, whoops, I meant to draw like this. We might get a, oh, dang it, I did it again. We might get like a head and shoulder pattern here, but we're in an ascending wedge. So, if it does create, it would be something that looks like that, something that looks like that. But do you get what I'm saying, Dale?
Yeah.
I mean,
so,
we used to always go, oh, it's the taxi cab driver, it's the shoe shine guy. When, I walked through, I remember, I used to travel quite a bit, from city to city, teaching people how to trade the markets back in the 2000s. I would get my shoes shined before I'd do, as I was running in town, and shoe shine guy would be like,
buy this
stock markets, hey, I just bought some Microsoft, and you're like, oh, I'm gonna go sell some. You know what I mean?
I know. We were trained that way, that when the guy in the street is an expert in the market, that it's got to be close to over. Now it's a different regime. All the old stuff has passed away as we've gone through this new paradigm, and now the little guy banded together. And maybe that's it, Blake. The little guy, the shoe shine guy, they were, they didn't have thousands in their communities and get together with every shoe shine boy in the globe and have a big club and everyone put $2,000 into something. They just had their tips to do whatever they want. So now it's kind of like a mass gathering of retail is different than the individual retail trader.
Yeah, and you know, it is definitely a different world, and you know, the markets are constantly evolving, but I think a lot of the same rules do apply when you get, you know, mass hysteria. You get everybody, you know, there's going to be people that are late to the party. It's identifying who those people are, and when you see them, you know.
I mean, Blake, what do you think about this new thing? I mean, people are paying $1 million for tweets.
Huh?
For tweets, they're buying people's tweets. The art in tweets. People are paying
Oh, the
$500,000, $1 million.
NFTs. It's I think that all that digital crap is just, it's crazy. I mean,
Yeah.
and I'm a collector of art. My wife and I, that's one of the things that we really enjoy is fine art. And we always have. And I just, I don't get it. I mean, I get it, but it's like,
Yeah,
if I can't hold it in my hands and be able to appreciate it, you know, in person, I don't get
like
it.
Bitcoin.
Yeah, I mean, you could argue that
Well,
too.
I guess. Yeah.
You know,
Everything.
yeah,
Money got too loose, and you know, the SPACs, NFTs, everything.
yeah.
You know.
And anyway, hey, I want to point this out before Steve and Stelios. I'm gonna pass it over to them because I want them to be able to, you know, talk about whatever they want to talk about. But I want to say that, you know, the S&P is at highs today. I know today's Tuesday. I know it's, you know, people tend to, you know, think, oh, it's Tuesday, it's turnaround Tuesday. It's Tuesday before the Fed meeting. So remember, I'm excited to hear what Mark Chandler has to say today. Mark Chandler is, I consider him a friend. He actually sent me a copy of his book, a signed copy of his book, and he's a nice and probably one of the most respected currency analysts in the markets today. And I've known him for years, and he is just full of the most amazing knowledge. If you haven't, you know, ever read any of his books, you know, his Mark Making Sense, I'm trying to think of his latest book. It's behind me, about 4 feet behind me, so I can't get up right now to go grab it. But you know, if you haven't read any of his books, you should. He is, you know, really one of my favorite people to listen to in the markets, to get a good macro idea of what's happening in the markets. So make sure you stick around for Dale's interview with Mark here in the next 12 minutes or so. I know I'll be here listening in. So with that being said, Stelios, Steve, how you guys doing?
Good morning. All good here.
Good morning.
Hey guys.
Hey, you played hooky yesterday.
Yeah, welcome back, Steve.
Yeah.
Thank you, guys.
Yeah, we didn't know you were going to be gone.
Yeah, I had told Stelios actually, but you're right, you didn't.
We knew.
Yeah. All right. Well, cool. Well, welcome back. Well, we have Mark Chandler coming in today, and
which is amazing.
Yeah, which will be great. And I'm going to turn it over to you guys as we continue to rally to all-time highs in every market, everywhere, all around,
throughout the cosmos.
So you guys have fun. I'm gonna, but before I go, I just want to mention, if you guys haven't visited our webinar sponsor, make sure you go to where it says ForexAnalytix sponsored on our website, Pepperstone Securities. Open an account with them. Then you can actually get ForexAnalytix, the app, the platform, for free for up to 4 months. So if you live outside of the US and Canada, so check it out. All right, guys, it's all yours.
Good luck today, Blake.
I'm very excited about Mark Chandler. I really like him. So what have we got today? Well, we don't have anything new. We're all waiting for the FOMC tomorrow, I guess. And we have the Bank of England on Thursday as well. So it could be an interesting week, but I don't
holding my breath.
Holding our breath, yes. I don't. Again, just like last time, I don't see what will make Jay Powell say anything different. Obviously, he has to address at some point the issue of inflation and yields rising. but so far it's only a blip. So it's not, in the grand scheme of things, it's not a lot. Obviously, it can become a lot, especially if yields, as I've said before, if they keep creeping up slowly, I don't think they're gonna make the Fed or the markets really take a lot of notice. But if we get a nice, like, proper violent move, then there's definitely going to be action. But for now, I think we have to wait, unfortunately, more.
Can I ask you this, Del? Any blowback from the AstraZeneca vaccine being pulled in several European countries? I mean, the UK has been doing very well in
Yes.
their vaccination effort, but Europe now way behind the UK, and not being able to use AstraZeneca's vaccine could even delay it longer, right?
As far as I know, we're still using it here, by the way.
We
Oh,
are,
really?
yeah. They are considering it now. They're having. I read the headline just a little while ago that they're going to have a meeting about whether to continue using it or not. But they are, and you're
Okay.
right, Dale. In Europe, it's one of the vaccines that probably the one
But
that is most.
by the way, if for some reason they don't want it, or if any of you has the AstraZeneca vaccine and you don't want it because you're worried about like the minor chance of thrombosis, please send it over to me. I have 0 chance of getting that anymore.
Yeah, it's like,
I'm in blood thinners, so send it over.
I think it's been what, 45 cases in 17 million shots. So you wouldn't call it a big.
Stelio, that's the fun part. That's what I was explaining to my wife and friends. I got a pulmonary like embolism like 2 weeks ago, which was like an almost impossible scenario for my age, and medical background. Imagine if I had got a vaccine like a few days before that, right?
Yeah.
Now try persuading anybody that it wasn't due to the vaccine.
Yeah.
You know what I mean?
You're right.
Everybody would be like, yeah, I mean, the guy was like young, he was healthy, no chance. I mean, he got it due to the vaccine. You know what I mean?
Well,
Yeah, that's a great point.
I wouldn't call you young, but yeah, okay.
You
That's a good point, though. You're right. All these cases,
yeah.
most likely there was something there to begin with, and anyway,
He's young at heart.
He's young at heart, yeah.
Yeah. So anyhow, anybody?
By the way, you said you were explaining to your wife. You never explain to the wife. She's always right. Don't forget that. Okay.
Very, very good.
I learned a good trick. You guys ever do this when you're in an argument? Just look at your shoes.
No.
No.
That's a good trick, though.
I'll
try
anyway. All right.
Yeah,
Someone gave me a tip.
I think your point, though, Dale, about Europe and the vaccine is important, because the US, for example, are way ahead now. The UK is way ahead in vaccinations. The UK, I think, more than the US. I think they've vaccinated something like 30% of the population. I can't remember the exact headline that I read, and I thought, wow, that's really amazing. So Europe is playing catch up, and it might have an effect. It's one of the reasons why, in the very short term, I don't like the euro that much, but remains to be seen.
The U.S. is now the woods. Either it's spring break here. I mean, Florida's packed. All the spring break places are packed, and we're on the verge of the UK variant becoming dominant. So we do have some protection, I guess, from the vaccines. That's why they're continuing to give them out. But Moderna's already working on a booster for the variants. Okay. So there's going to be another jab probably in the fall, probably for 10 years.
Okay. Wow. 10 years.
Yeah.
Yeah. I guess
let's see.
Big Pharma are going to like that.
But Steve's call about this being another wasted year from his sources, the variants could definitely turn it into that.
Yeah.
Yeah. Unfortunately. But yeah, we'll see. I mean, being optimistic is a good thing, but on the other hand, being unrealistic, is definitely not a good thing. Having said all that, what are the markets doing? The markets are playing in the same tune, meaning, S&P has now also confirmed like new highs. The Nasdaq has still to do some catching up. So it's been lagging a bit. I mean, nothing to really write home about, but it has been lagging a bit. We know that the DAX was the first one of the big indices that made the move along with the Dow. And in any case, we do know the strong correlation between the DAX and the Dow. So in this case, they also showed the way higher together. Dow also breaking through this channel as well, so looking very strong, has now even been trying to invalidate the RSI divergence having to do with the Dow, because as you see, for example, the S&P RSI divergence is still there and quite prominent. Now, as long as that's the theme, there is no real reason why somebody should be really bullish the dollar. I mean, I said some time ago there's a chance that we would see the dollar rebound, unfold, and give us a proper rebound finally. But if you remember, I started saying that at the beginning of last week that, if that was it, having to do with the correction of the indices, the chances that the dollar's rally could survive, is near zero. So, clearly the DXY has, reversed lower. Now, if this is going to be the beginning of another leg lower to new lows, I think we're about to find out, because we already had one leg lower. We had a little bit of a rebound. If you see this move now accelerating to the downside, I think most likely we've seen this swings high in the dollar. So, there is more to come. Now, on the other hand, if we see something different from the equities and the dollar still, not accelerating to the downside, we might get something different. But for the time being, is the status quo is still playing out. Other risk-correlated assets are either consolidating near the highs, for example, like crude is doing within this channel, or here is copper.
Yeah.
Or have already broken out. There is a chance that copper has already broken out. I know this might end up being like a more complex correction to,
ABC.
yeah, it might be a more complex correction to the downside, but there is also the chance that that was it, right? We're soon going to find out if that was the case. I mean, if it is to be a more complex correction, we might see it unfold differently, and we will have to redraw. But that's a problem always with corrective moves. It's very hard to guess the structure from the very, very beginning. Sometimes it looks like it's clear, then it produces something more complex. You need to readjust, so on and so forth. Precious metals, have found a bid. I mean, especially I pay close attention to where gold found a bid, because it was a key confluence.
Friday, Friday really recovered very nicely.
Yeah, so far. And here is silver, which also found support at the 25 area, which was also the 61.8% fib. Now, I know there is still the interpretation that we've broken down from this channel, and we might have a more complex correction unfolding here. So, the last few days are not really the trader's dream, because there are periods in a market that you have a clear trend, and there are periods in the market that you have an environment of consolidation, and still you're uncertain what kind of a consolidation you have in hand. So now, the big question mark in my head is this a consolidation of the rebound in the dollar, and there is a little bit more rebound to follow before we continue the trend, or is the rebound over? And, I don't have an answer to this question. I need more price action to have this answer to this question. And it's okay. It's not pleasant, as I said before. I mean, it's, as a trader, you would always wish to have,
A view.
100% clarity, right?
Yeah, or at least 50%, 80%.
Yeah, in what's happening. But that's not always the case. And instead of trying to fight it, instead of trying to force yourself to have a strong opinion, I think it's better to just go with the flow. I mean, when things are not so clear, just go along with it. Yeah, observe until you start feeling confident again that you now have a grasp of what exactly this type of move is about.
Amen.
Yeah, so I wish I could come here every single day, as I've done many days in the past, and say, listen, this is how things are. I'm confident we are in a downtrend or whatever, and we should be moving lower from here, blah blah blah. But the last few days, I don't have the confidence to tell you with certainty what's happening. And I've explained the reason a billion times. Corrective moves are not easy to decipher since day one. As simple as that. Now, the general trend in my mind hasn't changed. The general trend remains that risk assets should remain more or less well bid. Of course, there are going to be exceptions to the rule, and the dollar should continue to getting sold off. But on the other hand, we know that sentiment had become a little bit extreme, and in such a scenario, it's easy for you to have counter trend moves that extend more than you initially expected.
Right, Steve. Mark is
Dale?
in the house.
Okay, great. That's what I was about to ask. Okay, I'll stick
Okay.
around. Of course, I want to hear what Mark has to say.
Okay, let me get you set up, Mark.
By the way, we got negative retail sales numbers, quite below expectations. Anyway, let's get Mark.
Yeah, let's see.
Yeah.
Let's see. -3 versus -0.5 expected, by the way. But still, we had extremely strong revisions. That needs to be
yes,
said
absolutely.
as well.
Yes. Okay.
Okay, Mark, welcome back to Face. Hiya, Mark.
I can see he's still muted.
What's he saying here?
Mark, you need to unmute yourself. You're still muted.
I'm seeing it. Yes, there you go.
There you go.
There you go.
Mark. Good morning, everybody. Sorry about that. A little boomer accident.
Good morning.
Okay, welcome back to Face, Mark. Always a pleasure to have you here. And, a lot of people are, strongly neutral with what's happening in the dollar lately. And maybe you could give us some clarity. What are we looking at? Is this a new index that I saw a tweet several months ago that you had some type of new index that you were paying attention to with the euro? Do you know what I'm talking about?
Yep, sure, Dale. So what I did about, everybody talks about the dollar index. And as you know, the dollar index, it's tradable, which makes everybody want to use it. But in reality, it doesn't. What does it really mean? The dollar index does not include two of America's two biggest trading partners, China and Mexico. The dollar index is heavily weighted towards Europe. So I thought that for my clients, which are mostly corporations these days, that they needed something more useful than the dollar index. And so I helped, working with Bloomberg, we created a GDP-weighted currency basket. Top 12 countries in the world. 6 of them are emerging markets. 6 of them, of course, the majors. And just to put it in perspective, so the US is about 30%. The Eurozone and China are each about 20%. What I wanted to show you today, really, and this might help clarify Steve's point, I think, which was really that right now there might not be a clear trend. What this chart is this chart is really what the Federal Reserve looks at. It is a real, meaning it's adjusted for inflation, broad, meaning it includes the all the US trading partners. So real, broad, trade-weighted measure of the dollar. And this goes back to the breakdown of Bretton Woods in the early 70s. This is really the story, Dale, of your and my careers in the financial markets. Yeah, and what it shows us is that there has been 3 big dollar rallies since the end of Bretton Woods. The first one, the Reagan dollar rally. The second one, the Clinton dollar rally. That's the Clinton tech bubble. And now we've had this Obama/Trump dollar rally. And in my work, I think this third dollar rally is over. And I thought so, though, since really late 2019. And of course, when the pandemic first struck, you can see here the dollar, this broad trade-weighted measure of the dollar made marginal new highs. We saw that, like the euro breaking down. We saw the dollar yen spiking. But I think this is still rolling over. And Steve's point, of course, in the short run, the dollar has been well bid really since January. So for me, this dollar up move is 2 months old plus. It's corrective in nature. It relates to the big sell-off we saw following the election. Well, early November, two big things happened, right? The election, but also was the vaccine announcement. So to me, a new world like unfolded in early November. And what we've seen in January, February, and a little bit here in March is just a correction to that big dollar sell-off.
Okay. All right. So with this new index that you've created, are there any emerging markets that really they suffered a lot under a strong dollar regime, where there could be outsized moves? I mean, countries like Russia or Brazil, or some of these countries that a strong dollar, because a lot of them have debt denominated in dollars. A weaker dollar is going to be relief for them. I mean, you're already seeing it with money flows into international funds. Are there any plays on probably more speculative currencies in that arena than just the majors that we're focused on here?
Well, I do think that, for a lot of us, it's really that we focus on the majors, maybe a couple of the emerging markets that are liquid and accessible. But
Yeah.
I think that, when you look at the how the world is shaping up, so what's happened is we've seen a big jump in rate in U.S. interest rates. And this, as you mentioned, hurts some emerging market countries. Part of the strength, for example, of the Mexican peso, second strongest currency in the second half of last year, up about 15.5% or so. What was driving it was relatively high interest rates compared to most other emerging markets as well as major countries. But since we've got this backing up of U.S. interest rates, those countries that relied on high interest rates to bring in world savings have sort of fallen out of favor. And so when I look at the emerging markets just so far this year, from a big picture, 4 out of the 5 worst performers are in Latin America. This is where you tend to get the high yields, which a lot of those
Right.
fixed income fund managers like. So Mexico, Brazil, Argentina, Colombia are 4 of the 5 weakest currencies. And so I think that that's an important signal that despite strong U.S. growth, that interest rates sort of trump the growth channel.
Okay, so that too is interesting. With what rates have done, this rate scenario, Mark, there's a lot of company now on the reflation trade and what's happening to yields tripling on the 10-year, et cetera. Do you think that this move in yields is the beginning of something big, or some contrarians, I forgot the guy's name. There still are people. The story changed from last year, everyone talking about negative rates possibly happening even here, to that yields have bottomed and there's only one way for them to go. Is it possible that we still get yields going back towards the lows that we had during the COVID crisis, or that's something that we may not see for generations?
Yeah, Dale, isn't that great? For our career, say 30 to 40 years, interest rates in the U.S. have been trending lower. Inflation's been trending lower.
Yeah.
And now a lot of young pups want to say, this is the end of the 40-year downtrend. I wish it was. I'm not convinced it necessarily is, but here's what I think is happening. I think both of your points are right in the fact that we can have negative interest rates, but also higher bond yields. The Federal Reserve and the Treasury, I should say, are still struggling with reducing the Treasury's cash balances. This means fewer T-bill issuance, and this has had an impact, driving some interest rates negative. I know for most of us who are trading our own accounts, the plumbing, the short end of the curve is really dominated by banks, and we tend not to pay much attention to it. But the general collateral repo rate. So if you have a treasury bond, you're at a bank, you have a treasury bond, you want cash for it, so you repo it. You give it away to get the cash, and then you're going to unwind that. Well, those general collateral repo rates have gone negative. So we do have at the very short end of the U.S. curve, part of the plumbing that's behind most of the walls that we, as individual traders, look at. But some of those interest rates at the short end of the curve are negative, and the weight, the heaviness, won't go away for a couple more months until this adjustment is made. And this all has to do with our dysfunctional fiscal policy. In July, we had the debt ceiling, and part of the agreement is that the Treasury will bring down its cash position back to where it was when they extended the debt ceiling. At the long end of the curve, though, that's really most of us focus on. And
Right.
here's what I see happening, and this is why I think it's important ahead of tomorrow's FOMC meeting. For ballpark, the U.S. 10-year yield has gone up about 72 basis points since the end of October. That's the election and the vaccine announcement. So the nominal interest rate's gone up 72 basis points. And as you know, the yield has two components. One is the real yield, and the other is a risk premium that in the US we just reduce to inflation. So what I do is I look at the increase in the nominal yield, 72 basis points, and I say how much of that increase is due to inflation expectations. And it turns out that the 10-year break even, this is the difference between the conventional bond and the inflation-linked security, that has gone up. That inflation expectation has gone up about 58 basis points, which is to say that the bulk of the increase in yields is due to inflation expectations.
Okay.
And that's not good enough, I think, for me. So I drill a little deeper and I say, well, what's driving inflation expectations? It could be the large fiscal stimulus. It could be the idea that the Fed is printing money, quantitative easing, $120 billion a month, and there's no plans to end it. Or, and which is I sort of like just sort of growing up in the markets, that sometimes it's the KISS method. Keep it simple, stupid. So at fear of oversimplifying, I think that the bulk of the rise in yields, is due to inflation expectations. The bulk of inflation expectations is due to one thing: higher oil prices. And the higher oil prices have very little to do with Fed monetary policy or the fiscal policy. It has to do with the supply and demand in oil. It has to do with OPEC plus decisions, who surprised a lot of people, including myself last month, when they decided to continue their output restraint. So higher oil prices, I think, are the key variable driving inflation expectations, which are driving U.S. interest rates, which have given the dollar a little bit better of a bid in recent weeks.
Mark, we've had a pretty good move in U.S. dollar yen from 102.5 up towards 109 or so. Do you believe in the correlation of higher U.S. dollar yen is tied to yields rising? And can you explain the move in the yen? Does it have legs, or do you think this is just corrective as well?
Yeah, isn't this a great day to talk about the yen? Today we're going to have the 50 and 200-day moving average cross. And I know some people call it the golden cross, some people call it the dead man cross, depending on which side you're on. But today's the day where we're crossing there, and it's sort of an exciting technical day. So I do, in my work, I find a very strong correlation right now, and that's not always there, but it is there now, between the U.S. 10-year yield and dollar yen. So, for example, if we think that we're going back to late 2019 like levels, that would put the U.S. 10-year at about 180 basis points. And I think that would put dollar yen a little bit north of 110. Last year, we made a high around 112, 30, 35, something like that. I don't think we get back up there, but I think we do take out that 110 level. That's a sort of an important psychological level. But here, too, I think that the move is sort of long in the tooth. I'm not seeing the divergences that we see in some of the, say, what Steve was pointing out with the some of the equity indexes. But I do think that the technical momentum indicators I use, like the slow stochastic or the MACDs, are very extended, and I'm just waiting for them to give me some sign that they're getting tired.
And anything on the commodity currency front, the Aussie, the Canadian, that's catching your eye? Canada's been very strong, USD CAD very weak. Is that because oil prices have been strong, or is it economically based at Canada, that their currency has been stronger? You know, really an underperformer. Even when the dollar bounced in the last couple of weeks, USD CAD continued lower. What do you think is behind that?
Yeah, so of course, a lot of North American corporates have a lot of exposure to Canada. It's a lot of trade between us. So it's one of the things that are always on my radar screen. I find that there's three factors, like variables, if you will, that influence dollar CAD. One is the general risk appetite. I use the S&Ps as a proxy for that. I find the Canadian dollar is among the most sensitive currencies to sell-offs in U.S. stocks. I use oil as a proxy for commodities. And then I also look at the short-term interest rate differential. And here's what I think is happening. You see those Canadian jobs numbers at the end of last week? They were very spectacular. And what this means, I think, is that, so it's sort of like we all got hit with this shock at the same time, pandemic. And policies, different countries pursuing different policies. So we're at a point now where we have to think of who's coming out first. Which central banks are going to be the first to pull back on their monetary policies? Norway, who said the central bank meets later this week, is the top candidate, but Canada is a close second. In fact, next month at the Bank of Canada meeting, it seems to me likely that the Bank of Canada gives us some signal that it plans to taper its bond buying. Right now, it's buying about 4 billion Canadian dollars worth of bonds a week. And so I think that we could see Canada beginning to reduce its bond buying. It's still a ways away from a rate hike, but the strength of their labor market is impressive, especially compared to the U.S. So I sort of use this rule of thumb that Canada is about 1/10 the size of the U.S. So when they create 200,000 jobs in a month, that'd be as if the U.S. created 2 million. And I'm looking for a strong jobs number from the U.S. next month, or for this month in March. But Canada's numbers, it just seems to me they're a bit ahead of us on rebuilding the labor market. And I think what this will set the stage for, it's not going to be on anybody's calendars, but as you know, Canada has a minority government, and it typically lasts about 2 years. And I suspect that this could be the year that Prime Minister Trudeau calls for an early election. Maybe it's late Q2, early Q3, on the back of this better performing economy.
Interesting. Look, there anything on Aussie? You know, that Aussie seems to be tied to, you know, what's happening with China. The commodity complex really had a nice run before this recent pullback. What do you think, Mark? Aussie, a continuation move to the upside with commodities still acting okay, copper, gold.
I lost you for a second. I think that this is the difficulty of working in a third world country, a third world infrastructure here in the U.S.
Yeah, how about that?
Yeah. So looking at the Aussie a little bit closer, I think that Aussie's correcting a little bit. Australia, you know, today's another important day for Australia. Earlier today, the U.S. is saying that it will cannot normalize relations with China as long as China is harassing Australia for its foreign policy. Of course, Australia is a key ally of the U.S. It's been punished through a bunch of trade sanctions from China, which is its biggest trading partner. And so I kind of like this background. Also, you know, Australia has taken on a lot of challenges this year, right? Besides antagonizing China, it antagonized Google and Facebook. It struck a deal with them. I think that Australia, interesting country to be watching here. I don't see it as so much tied to China as I do to commodity prices, which of course are related to China, but also Australia is I'd see it as a nice proxy for broadly commodity prices and also interest rates. Amazing story here. They are targeting their 3-year note yield at 10 basis points. And talk now is they're going to extend that for more than another year. And so, because right now they're targeting the April 24 note, they might target the November 24 note. And so Australia is here for a while. with soft monetary policy. And I think the strength of the Aussie compared to the other dollar block currencies gives the central bank, sort of buys them more time before they have to adjust monetary policy. The other point I'd say about the sort of Anglo-American economies, UK, Canada, Australia, New Zealand, house prices. I think this becomes the next, well, we already see a rising issue for central banks. It's not the dominant issue, but I see it's a rising issue. Easy money, especially in these types of economies, fuels what could be elevated house prices.
They're certainly elevated here, aren't they, Mark?
Mine is never elevated enough, but I think my neighbor's is. And by what I mean by that, of course, is that more households own. So the IRS says more Americans live in owner-occupied places, apartments, condos, houses, than own equities. And so when I think about the wealth effect broadly in the U.S., of course, income is an important part of that. But out of the assets that we have, I think house prices are more important for long-term wealth in America than the equity market.
Did you ever think that they would surpass the 2008 levels when we were in such a bubble? I mean, I believe in echo bubbles, but they're usually not as dramatic. And I mean, people are in certain areas, especially in California, you put a house on the market, Mark, and they're coming in with offers above the asking price and at times still not getting the house. Do you think what's happening with the mortgage, I forgot what the name of the program is, where you could just, what they've done to assist homeowners, what is that called again, where your mortgage payment is put aside?
You mean they make it to defer the mortgage payment, interest payments?
I forgot what it's called, but anyway, that's going to end, I believe, in October. Do you think that there's some type of perhaps some mini supply issue with people that have not been able to pay their mortgage for almost a year, are not going to be able to come up, or are the banks and Biden just going to have them tack that onto the end of the loan where it won't be as deleterious?
Yeah, this is a real problem, Dale, for me in the U.S. I'd say that, to me, in addition to the climate change issues, what concerns me is the disparity of wealth and income and really power, not just in the U.S., but really major countries and many emerging markets. And so I think that what's happening is that even though, we saw these figures last week, household net worth in the U.S. jumped. Where the U.S. as a whole is wealthier than before the pandemic. However, the way it's distributed is probably less fair. And so what I think is going to happen, a lot of us are looking at these savings rates, and see that American households have what some people call excessive savings. And I think a good chunk of that is going to end up to be used for exactly what you're saying. The forbearance granted to mortgage holders. Forbearance, it was granted to mortgage, to borrowers. It doesn't really forgive them of the loan. It doesn't really say they don't have to pay it. They just buy some time, and they're still accumulating the interest on that unpaid part. And so it does seem to me that some of this high savings rate that many people think is going to fuel consumption is really going to fuel debt servicing. I know a lot of people who are sitting with lots of cash, who aren't going shopping, who aren't buying things because they know they're going to have to pay their landlord. And in the meanwhile, they're building up their savings, improving their credit ratings. But this is a concern, and this is part of this fiscal cliffs that we should be expecting. And I think that fiscal cliff, even the unemployment compensation that was in this new stimulus measure, it only extends till September. And what concerns me is these date specific as opposed to condition specific. If it would be unemployment compensation could be extended until unemployment is below 5%, or that this forbearance on paying mortgages can be done until the unemployment is below 6%, or come up with some economic number as opposed to some date. Otherwise, we're going to have these fiscal cliffs, and that's what we're going to be trading off of.
Interesting. All right, so something to look forward to in the fall. Before I let you go, Mark, I have to get a couple of comments. First of all, crypto. Just a comment.
Crypto. I think that crypto is money in the same way my wife is Catholic. Self-identification.
Okay.
If the Bitcoin would have called, if they would have said, you get a token for solving this energy-intensive computer problem, and how much is it worth? I think that if it wasn't being called coin, if it wasn't being called money, it would clarify what's really going on here.
Okay. And the other thing is,
somebody would say
Steve.
that I love Mark because he's like an echo chamber to me. But really, I mean, I wish more people were logical enough to we wouldn't have this kind of ridiculous markets.
All right, I want to wrap it with this, Mark. You and I and Steve, maybe half as long, have been in this business a long time. We were always trained, and Blake was talking about it today, on how when the retail guy got involved in the market, it was pretty close over the shoe shine boy, the cab driver, giving you stock tips. To me, seeing little guys in large groups come together and squeeze hedge funds is, I believe, a new paradigm, where the retail trader on his own might be meat for the pro to gobble up, but in large groups, it seems that they have more power than I ever thought that they could. Do you think it was them, or it was big hedge funds using these communities, as a cover for what they were doing?
Yeah, I was fascinated by this. Of course, I don't trade GameStop. I'm not really involved in that space, but I do marvel at this because, before we had corporations, there were all kinds of attempts for capital to come together, pools, trusts. And the reason that these broke down was because the agreements cannot be enforced. And so it's one thing to have this sort of, I think that the GameStop probably a one-off, but because here's really the issue is it might be easier to get people to buy, but how do you organize the selling? And the incentives is for people to defect early, so they're not the last one holding the bag or stock in this case. So I'm suspicious that this can really be duplicated in a planned, organized fashion. But of course, the democratization of the capital markets poses a challenge to the big pools of capital.
Yeah. And I'm going to ask this, Steve Volge has, brought up many times that Russia's debt to GDP ratio is really in great shape compared to, our more mature countries, developed countries. You have a view on Russia? The ruble did start to strengthen in the last year or so. You think the ruble might be a place to take a long shot spec on ruble appreciation?
I do. I mean, so from a big macro point of view, you've got a country that has dollar receivables, and so the dollar bonds look attractive to me. The ruble looks attractive to me as long as you're bullish oil. I sort of think about the ruble as a proxy for oil. But in general, for many of us who are concerned about, aiding the enemy, so we don't want to buy so much Chinese stocks or Chinese bonds, the government tells us, because it's funding the People's Liberation Army, the Chinese military. And Russia is not a good actor. And I know that sometimes we trade, we want to separate our politics. But I think that Russia might be an attractive for the short run, but is the money really worth it? So yeah, bullish on oil. Russia's balance sheet looks attractive. High yields look attractive. But for me, I'd rather take money from another country than Russia.
Okay, so that goes back to a lot of people that want to buy EVs and invest and be socially responsible in equities. I guess you could be socially responsible in foreign exchange as well. Great way to end it, Mark. Go ahead.
Great. No, thank you very much for your time. I always enjoy chatting with you, Dale and Steve.
Yeah, so it was great having you, Mark, and we're not going to let as much time pass. Go ahead, Steve.
No, I mean, thank you, Mark, for being
Oh,
here.
okay.
We always enjoy it.
Yeah. Thank you so much, Mark. Good hunting, and we're going to have you back real soon. Okay, this summer sound good to you?
Great.
All
Good
right.
luck to everybody.
All right. Good luck. Good hunting. Congratulations on developing a new index that gives your customers and the rest of the world a better understanding of what's happening with an index that is broader and gives you a more definitive picture of the dollar. Very creative work. Congratulations, Mark.
Thank you. Good luck.
All right, so that's a wrap, everyone, for Turnaround Tuesday, and we'll see you tomorrow for Fed Day. Good hunting the rest of the day. You could join the Morning Edge in 15 minutes. Don't just count your rubles or your yen. Count your blessings, and we'll see you all tomorrow. Adios.
Bye-bye.
Thanks again, Mark, and thank you, Steve Volge. Adios.